YouTube, I hope you're having a great night. I know I am. Welcome back to the Trading with the Full-Time Job series, and now we're going to talk about using screens. So, a little history of stock screens. So, the earliest pioneer in the development of stock screens was our boy Ben Graham, Mr. Warren Buffett's mentor. He's often referred to as the father of value investing. The first time stock screens were introduced was in Ben Graham's book, Security Analysis. And even though he wasn't a technical man, he was, kind of the pioneer in what we do today. And his filters were more fundamental based, specifically on dividend yields, earning yields, and price to earning ratios. So now, moving into today, what's kind of the theory behind the screen? So you're going to want to look for assets that meet your criteria, and you can set that criteria however you want to. If you want to look for momentum, you can do a momentum screen. If you want to try to find value, you can do it that way. You can screen based on market capitalization. You can screen based on earnings growth rates, revenue growth rates, whatever your favorite fundamental ratio is. You can screen for that. You can screen for a country of origin if you only want to trade emerging markets. If you want to trade only U.S. stocks, or you can screen by asset class, commodity based, currencies, bonds, equities, all that kind of stuff. That's really the nuts and bolts behind the screen. But the most important thing to remember is that a screen provides a pond of fishing. A screen will not catch the fish for you. So why do screens work? They focus your universe of stocks. There's millions of different things you can trade every single day. And you want to make sure that you're looking for something that you feel comfortable trading. And you want to make sure it conforms to your market beliefs. A lot of people bring baggage with them to the market, and that isn't necessarily a bad thing if you're going to be able to capitalize on your baggage. So if you believe that everything's horrible and you're always bearish, that's fine, and you want to be screening for stocks that are going down. Why screens work? They're objective and they allow you to have consistent decision making. There's if you're putting in parameters and a stock doesn't meet those parameters, you're never going to see that stock. So when you are doing your screens, you're going to see only the stocks that you want to see, and it allows you to really filter out the crap and only go for the gold. And then it applies that systematic approach. Make sure that you're staying disciplined to only buying stocks that you want to buy, making sure you're hitting that pitch that you want to swing at. And it does that by following the parameters that you set those criteria up front. And it lets you create that structure and framework that kind of, really brings everything together and kind of hones in what you're looking at. So how to build your screen. First things first, they gotta be easy to use. You have to be able to modify it, and you have to be able to save it super easily. I use Charles Schwab as my broker. They have a super easy screening tool that's free for account holders. And then even if you're screening for cryptocurrencies, CoinMarketCap is a great screening tool. And I'll kind of go over these two later. The second thing you want to do is you want to have access to lots of data, specifically data that is relevant to you. From there, you need to define your screening criteria. You need to test and validate that your screening criteria is usable. And then you deploy it. And just because you deploy a screen doesn't mean it's going to go perfectly the first time. There's going to be revisions you have to make. Maybe you have to get rid of one filter, add another one in, maybe change its percentage. But it's going to take time for you to really hone in on the screens that you want to be seeing. So don't be discouraged if you have to go back and make some tweaks. That's where ease of use really comes in. You want to make sure that you can easily modify and save those screens as you see fit. So we've talked a lot about how screens are good for you, but we have not talked about how they can be bad. If you do much statistical analysis, you're familiar with the term curve fitting. And that's when you kind of go back and you cherry pick data to really make sure that you can find the optimal screen. And that isn't necessarily a bad thing, but it is if your screen cannot adapt to new market trends. So you want to make sure that you're keeping your screen as general and broad as you can, but also as focused and specific as it needs to be for you to meet your trading criteria. I know that's kind of, talking over each other, saying two things, but it's kind of that's the balance you have to find. So that's where over optimization can hurt you. Too many stocks meet the criteria. This is going to be, kind of a hindrance to you as well because you're going to be looking at too many things and you can get overwhelmed. You're also going to be looking at things that maybe you shouldn't be because they're not as good as what they could be. So this is where this first point here, you need to find the VIPs comes in. You want to make sure that you're freeing your mind from average returns. And to do that, you're going to have to specifically hone in on the stocks that you want to buy. Next thing is false signals and noise. So just because a stock shows up on your screen doesn't mean you immediately buy it, but then don't assume that any stock that breaks out after it's on your screen is going to work. Momentum is obviously trending, but it does have to end at some point. So just make sure that you're going to be understanding when not only your strategy fails, but your screener fails you. And then on that second point, a perceived leader can have all the great screens and it's in the perfect base. And then next thing you know, it just breaks down and turns into that market lagger. So there's going to be false signals and noise. That's always something that comes with trading. It's a life fact that we just have to accept. So make sure it's not going to hold you down too much. Last two things, chasing performance. So never enter a trade just because it meets your screening criteria. This is kind of what we've been going on. You really need to make sure that you're still following your trading rules. Screens allow you to select what you want to trade, but how you trade it is still based on your trading rules. So make sure you're using that risk management and make sure you're not FOMOing into trades. And then last topic here, ignoring context and market sentiment is going to hurt you in your trading. If the S&P is going straight down, but you're still screening for bullish stocks, some of them will work, but it's going to be a better percent chance that they go down in that environment. And then same thing, if the S&P is going up and you're trying to screen for stocks going down, it's going to be harder to find things that are meeting that just because the overall market sentiment is in conflict with what you're screening for. Using screens as sentiment. So if you see more stocks on the screen, it means there's broadening participation. If there's less stocks on the screen, it means there's weakening participation. So is your bear screen have more stocks available than your bullish screen? Maybe that means that the market as a whole is more bearish, and that's where you need to be planning your money. If you have more bullish screens than bearish screens, that means that the market is more than likely going to be in an uptrend. So you want to be making sure that you're following the direction of the market. Sentiment within screens can also be, a little bit interesting. At the bottom of a bear market, you'll usually see a momentum thrust, and a screen thrust can more or less be the same thing. If all of a sudden you see a bunch of names pop up after a long trend of, maybe only 30 or 40 names, that's a piece of information that you want to hold on to and make sure that you're starting to really add to your positions. And then the reverse is, if you're at the top of a cycle, if we're up at this euphoria phase and you see another, huge screen thrust, that could be the sign, that's your contrarian indicator that, maybe it's time to start lightening up and looking for some more shorts. And then the last thing to look for within the screen, it's always important to include the sector of the asset that you're trading within that screen. So if you're seeing a bunch of energy stocks starting to pop up on your screen, that's going to let you know that oil's probably going up, natural gas, coal. So what sector is dominating the screen? What is the sentiment with market participants? Screens are a super important part of your trading, and here are some people that completely agree with that statement. So William O'Neill, How to Make Money in Stocks, that's his famous book. He has a bunch of great earnings and momentum screens that you can kind of mix together and make your own. Mark Minervini, same sort of thing. James O'Shaughnessy, More of a fundamental guy in macro, but yeah, same thing. Joel Greenblatt, William Eckert, and Richard Dennis, the Turtle Traders, and then Peter Lynch, one up on Wall Street. So even the best traders and investors of all time use screens. So it's very important that you're doing the same. And then here are my screens for stocks. I break it down into 3 segments: momentum, growth, and market cap. For momentum, I want to see that the stock is less than 35% below the 52-week high. I want to make sure that the price change over the last 3 months is greater than 0, and I want to make sure that the price change over the last 52 weeks is greater than 0. For growth, I want to see that the EPS growth is, for the most recent quarter, is 20% higher than last quarter, and then I want to see that the trailing 12 months is 20% higher than the trailing 12 months of 1 year ago. And then I break this up into 3 different screens. I'll do a small cap screen, a mid cap screen, and a large cap screen. And then for cryptos, I use CoinMarketCap, like I noted, just looking for a year-to-date return. You want to see the percentage below all-time high, and then I look for the price change over the last 30 days. And then for market cap, I want to look for the up and comers. So I'm looking for 100 million to 5 billion. And then if we go to Charles Schwab, you can really see how robust this stock screening tool is. So if we're going to go over here, let's go to price performance. So percentage below 52-week high. We're going to go over here. We're going to enter our specific value. We want to make sure it's less than 35%. Then we want to make sure that our price change over the last 3 months and last 12 months, I want to make sure both of these are greater than or equal to 0, and then greater than or equal to 0. Next up, we have the company performance. So here's your EPS growth history. There's your most recent quarter and your trailing 12 months. We want to make sure that these are greater than or equal to 20%. Greater than or equal to 20%. And then going back to basic, there's your market cap, and that's where you can set small, mid, or large. So let's just do the large one. And you can see we have 72 stocks that show up on this scan. So that's an easy way to do that. And then looking at CoinMarketCap. So first thing you need to do is over here on the right side, go to customize. You can change around these. So I do from all-time high. There's your 7-day price, your market cap, volume to market cap, 30-day chart, and then the year-to-date percentage. And then I just sort by year-to-date. You want to make sure that you're staying in the highest momentum names with the most relative strength. And then you're going to want to look to buy some of these bases once they break out. So that's kind of the down and dirty on screeners. If you've got any questions, feel free to put them in the chat, and thanks for watching.